Welcome to this deep dive. We're cutting straight to the most important insights from the latest earnings calls, so you get the knowledge nuggets fast.
That's the plan.
Today, we're zeroing in on Telos Corporation, looking at their first quarter 2025 results and, the outlook management share.
Right. And what really jumped out this quarter, I think, wasn't just hitting guidance, but, a pretty dramatic turnaround in cash flow.
Exactly. So we're going to unpack the key financial shifts, how their different business segments performed, the latest on those big programs like TSA PreCheck and DMDC, what's on the horizon for next quarter, and the full year picture too. Let's dive in.
Yeah, the goal here really is to move beyond just, listing the numbers. We want to help you understand what's actually driving performance and, crucially, what management's forward-looking statements really imply about the company's path, based on what they actually said on the call.
Okay, let's kick things off then with the snapshot from Q1 2025. The overall tone from management, it sounded quite positive. They seemed pleased with over-delivering.
They did. They certainly beat on several fronts. Total company revenue hit $30.6 million. Now, that's a solid 16% sequential increase from the last quarter, and importantly, it came in above their guidance range.
And the bottom line looked much better than guided, too, didn't it? Adjusted EBITDA wasn't a loss, but actually a profit of...
It's $362,000, right?
Right, $362,000. Their guidance had been for a loss somewhere between $1.8 million and $800K, so that's a significant beat.
It was, yeah. A material positive surprise there on profitability compared to what they'd signaled. But I think the real headline, the number that should really jump out at you is the cash flow generation this quarter.
Okay.
Cash flow from operations was positive $6.1 million, and free cash flow came in positive at $3.8 million.
Positive free cash flow. Wow. That feels like a major turning point compared to, recent history.
Definitely.
So exceeding revenue guidance, beating handily on adjusted EBITDA, and generating positive cash flow to start the year. What was driving all this?
Right, and that's where the deeper dive into the Q1 financials becomes essential.
Yeah.
Let's break down that revenue growth. It wasn't evenly spread. Security Solutions, which is now, the much larger part of business, saw really robust sequential growth of 18%, hitting $25.8 million.
Okay.
Secure Networks also grew sequentially, up 8% to $4.8 million.
So Security Solutions really powered the top-line beat then?
Absolutely. Management specifically called out the strength in Security Solutions revenue as the main reason they exceeded their overall guidance. Now, looking at margins, both GAAP and cash gross margins also came in better than guided. GAAP gross margin was 39.8% and cash gross margin was 45.3%.
And why the margin strength? What did they say?
They put it down to a more favorable revenue mix within the quarter itself. Then, shifting down to expenses, adjusted operating expenses were also better than forecast. Came in about $800,000 lower than guidance.
Okay.
And that was primarily due to lower non-labor costs across different departments.
Okay, so a better revenue mix boosting margins plus some disciplined cost control on the OpEx side. That certainly paints a clear picture of how they delivered that adjusted EBITDA beat.
It does. Now, to really understand the state of the business, we need to put Q1 2025 in context. Look at the year-over-year performance compared to Q1 2024.
Right.
Overall revenue growth year over year was, a more modest 3%. But that single number kind of masks a fundamental transformation happening inside the company.
You mean the major mix shift we've been sort of anticipating?
Exactly that. The most significant year-over-year story is the dramatic change in their revenue makeup. Security Solutions revenue surged by a substantial 39% year over year.
39%, wow.
Yeah. Meanwhile, Secure Networks revenue contracted year over year.
And this isn't just a small tweak, is it? The proportion of revenue coming from Security Solutions went from, 63% in Q1 last year, all the way up to 84% in Q1 this year. That's a huge swing.
It really is. And that mix shift had a direct and positive impact on year-over-year gross margins. The increasing dominance of Security Solutions drove GAAP gross margin up 278 basis points year over year.
Okay.
And cash gross margin up 313 basis points. Now, this higher cash gross profit, combined with lower adjusted operating expenses, which fell $1.3 million year over year, partly a benefit from that restructuring they did back in Q3 2024.
Right, I remember that.
That combination led to adjusted EBITDA increasing by $2.7 million year over year.
So the strategic decision to restructure last year is actually contributing directly to improved operating performance this year. That's good to see.
Correct. And we see this leverage combined with they point to a few things. The Higher adjusted EBITDA, obviously, lower capitalized software development costs in Q1 this year compared to last, and favorable working capital dynamics. They also made a key comment about their expectations for the rest of the year. They said they anticipate this trend of year-over-year growth in revenue, adjusted EBITDA, and particularly cash flow to actually accelerate in the second half of 2025.
Okay, so they see the second half as where the full impact of these current program ramps really hits the financials hard, right? Numbers are one thing, but earnings calls also give us those crucial updates on the actual business operations, the progress on key programs. What were the highlights there?
Yeah, the two programs commanding the most attention are definitely TSA PreCheck and the DMDC program. For TSA PreCheck, they're continuing to build out that enrollment center network.
All right.
They added 73 new locations just in the last 9 weeks. That brings the total live locations now to 291.
73 in 9 weeks. That sounds like a pretty good clip, actually.
It is. Although, management did caution that the pace of opening new centers isn't necessarily linear. It could be lumpy week to week, month to month.
Sure, makes sense.
But they are still holding firm on their target, achieving 500 enrollment locations sometime around the end of 2025. And they couldn't emphasize enough how important TSA PreCheck is as a driver for their financials this year, specifically highlighting its significant contribution to that cash generation turnaround we just talked about.
So TSA is not just a revenue story, it's a key cash driver too. Good to see that rollout progressing. What's the latest on the DMDC program then?
The DMDC program is also ramping on schedule, as expected. They continue to view it as a major source of revenue growth over the next several quarters.
And how does that DMDC ramp impact the margins we discussed earlier? This seems like a potential point of tension, right? Big growth, but maybe different profitability.
You've hit on a critical point, and one management addressed explicitly. They stated that DMDC will be dilutive to overall company margins on a blended basis.
Ah, okay. Why is that?
The reason is that the lower margin revenue streams within that large, complex program are the ones ramping up first sequentially. So even as DMDC revenue grows significantly overall, its initial ramp will cause sequential overall gross margin contraction over the course of the year.
Okay, so DMDC is a major top-line growth engine, but it brings a near-term headwind for the overall margin percentage because of the specific mix of its revenue streams ramping up front. That helps explain the expected margin dynamics later on.
Precisely. Beyond those two major programs, they also highlighted some other recent business wins and renewals, just to show activity elsewhere.
Yeah, like what?
This included new orders and renewals within their exact business from customers like INF or various U.S. federal agencies, including the U.S. 16th Air Force and ONI, that's Office of Naval Intelligence.
Okay.
The New Zealand government, a leading cloud provider, and some other federal customers too.
They also mentioned a new cyber services order, didn't they, from a Fortune 100 tech company?
That's right. And important renewals in their AMHS business. That's the messaging system with the U.S. Marine Corps, DISA, Defense Information Systems Agency, and USOCOM, U.S. Special Operations Command.
Right.
So these wins, even if they're smaller than DMDC or TSA, they demonstrate continued momentum and activity across their portfolio, outside of just the giant programs.
So there's activity across the board then. Good. What about the new business pipeline looking forward? How large is it, and what's the expectation for winning new work?
Management described the pipeline as robust. Currently standing at over $4 billion across hundreds of opportunities they're actively pursuing.
$4 billion. Okay.
Yeah, it's a big number. They noted that award dates for this potential new work are kind of scattered throughout the remainder of 2025.
Over $4 billion is massive, but what does that translate to in terms of potential impact on revenue this year? Did they give any color on that?
They did, and that's an important distinction they clarified. While the pipeline is large for future growth, management's expectation is that incremental revenue growth from new contract awards won this year will likely be, and I quote, single-digit kind of opportunities.
Ah, okay.
So this suggests that the big growth drivers for 2025 are primarily the execution and ramp of existing large programs like DMDC and the ramping TSA.
Right.
Rather than significant upside from new wins landing and contributing revenue really quickly within this calendar year.
So the pipeline is more of a 2026 and beyond story, while 2025 is really about executing the big existing wins. Is that fair?
That seems to be the implication from their commentary, yes.
Yeah.
They also commented on the overall market for renewals, noting that it's expected to contract meaningfully this year, and they did see that contraction reflected in Q1, just as they anticipated.
All right, let's look ahead then. What guidance did they actually provide for the second quarter of 2025?
Okay, for Q2, they forecast revenue between $32.5 million and $34.5 million. This represents solid year-over-year growth, somewhere in the range of 14% to 21%.
And how do they see the segment mix shaking out in Q2 compared to Q1, that continuing shift?
Yeah, the mix shift is expected to continue accelerating. Security Solutions revenue is projected to grow very strongly year over year, somewhere in the low 60% to low 70% range. Again, driven primarily by the ramp of DMDC and TSA.
Okay.
Conversely, Secure Networks revenue is expected to contract significantly year over year in the low 70% to mid 60% range. That's due to the completion of programs in prior quarters.
So that transformation really accelerates in Q2. Given the commentary about DMDC's margin profile ramping first, what does this accelerating mix shift mean for expected gross margins in Q2? Down, presumably.
Yes, exactly as anticipated. The rapid growth of those lower margin programs within Security Solutions, combined with the wind down of some legacy higher margin Secure Networks work, is expected to pressure overall gross margins, both sequentially from Q1 and year over year.
Okay, what are the numbers?
They forecast GAAP gross margin in Q2 between 32% and 33.5%, and cash gross margin between 38% and 39.5%.
That's a noticeable step down from the Q1 margins we just saw.
It is, yeah. And they were clear that this is a direct result of that changing revenue mix. However, on the expense side, they do expect cash operating expenses to be lower year over year in Q2. Forecast is about $1 million to $1.3 million lower, thanks to those 2024 cost reduction initiatives finally flowing through properly.
Right. And putting that all together, what's the expected adjusted EBITDA picture for Q2? Still positive?
No. For the second quarter, they are actually forecasting an adjusted EBITDA loss in the range of $2.1 million down to $600,000.
Okay. A loss expected in Q2. And did any of this change their view on the full year?
No. Apparently, the full year outlook remains unchanged from their prior guidance. They just reiterated the components. Roughly $70 million from the existing business that excludes the large DMDC and Q1 24 DHS wins, plus an estimated $50 million to $75 million specifically from DMDC and those DHS programs. Plus the revenue contribution from the ramping TSA PreCheck enrollments, and finally, any potential incremental revenue from new business wins landed this year, which, as we said, they expect to be modest this year.
Okay. We've covered the numbers, the programs, the guidance. Let's try and connect the dots here. For an investor listening, why do these specific details really matter? What's the big picture takeaway?
Well, what's fascinating here, I think, is watching a company in transition play out in the numbers. Security Solutions isn't just a bigger part of the business anymore. It practically is the business now, right? Representing 84% of revenue year over year in Q1.
Yeah.
And this transition fuels faster overall growth, driven by these big programs like DMDC and TSA.
But that high growth in Security Solutions, at least initially, seems to come with a trade-off on margins, as we see clearly in the Q2 guidance.
That's exactly right. The margin story is complex right now. You've got the shift between the contracting Secure Networks and the growing Security Solutions that actually helped year-over-year margins in Q1. But then you have the mix within the rapidly growing Security Solutions segment itself.
Right.
Specifically, the lower margin DMDC streams ramping first. And that creates this sequential margin pressure they're forecasting for Q2. It's kind of the cost of scaling these new large programs, even while they maintain discipline on operating expenses thanks to last year's restructuring.
And you highlighted the cash flow story earlier as particularly important. Can you elaborate on that a bit more? Why focus there?
Look, the turnaround to positive cash flow from operations, and particularly positive free cash flow in Q1, that's a major point. And management emphasized that they expect cash flow to meaningfully outperform adjusted EBITDA in the second half of the year.
Outperform EBITDA?
How? They point to factors like the accounting treatment of certain TSA costs that hit EBITDA, but are structured differently for cash flow purposes, and also favorable working capital movements they anticipate.
Ah, okay.
So for an investor focused purely on profitability metrics like EBITDA, they might actually miss that the underlying business is generating cash much more effectively than the P&L might suggest in the near term. And positive free cash flow, well, that provides balance sheet flexibility, and it's a tangible sign that these scaling programs are delivering real value.
Right. Cash is king, as they say. And finally, how should we reconcile that large, over $4 billion pipeline with management's expectation for only single-digit incremental revenue from new wins this year? What's the message there?
Well, this raises an important question about the timing of future growth, doesn't it? The large pipeline indicates substantial long-term potential, clearly. But management's guidance implies that the significant impact from converting that pipeline is largely a story for beyond 2025. It's separate from the already ramping DMDC and TSA programs, which are the primary 2025 growth engines.
Got it.
It really means 2025 is heavily focused on execution, on scaling these existing big wins, with potential upside from new bookings not expected to contribute significantly to revenue within this calendar year.
So 2025 is an execution year on current large programs, building the foundation, while the massive pipeline hints at what could come later.
That's certainly the picture painted by the call commentary, yeah.
Okay, let's do our This Is Not Financial Advice segment. Time to channel our inner hedge fund analyst. Pitch an outrageous but plausible trade idea based only on the information we've just discussed from the earnings call.
All right, let's do it. Imagine you're in the room, right? The consensus view is likely focusing on that expected sequential margin contraction Q2 and maybe the projected EBITDA loss. But you've zeroed in on that cash flow line.
Okay, lay it on us. What's the pitch?
The idea, go long Telos, ticker TLS, specifically because the market is dramatically underestimating the rapid and potentially structural turnaround in cash flow generation the company is projecting. Think about that data point again. Negative $40 million in free cash flow for the entire year 2024.
Abruptly shifting to positive $3.8 million in just Q1 2025. And management is explicitly saying they expect significant year-over-year cash flow improvement, and that cash flow will outperform adjusted EBITDA, accelerating in the second half.
That contrast is pretty stark, you have to admit.
It is. The outrageously plausible angle here is basing your conviction almost solely on this cash flow pivot. You argue that this unexpected cash strength provides a cushion the street isn't pricing in. It validates the scaling value of cash-generating programs like TSA PreCheck, offers financial flexibility despite the near-term gap or adjusted EBITDA pressures. You're essentially betting the market narrative will shift from worrying about profitability metrics affected by mix to recognizing the underlying cash-generating power sooner than expected. Maybe overlooking the sequential margin story because the free cash flow turnaround is just so compelling.
A bold call, putting cash flow front and center above all else.
Yep.
Definitely an intriguing perspective straight from the numbers they presented. As always, presented for illustrative purposes based only on the call commentary. This is absolutely not financial advice.
Absolutely. So to bring it all together then, what are the absolute core takeaways from this deep dive into the Telos earnings call? Quick summary.
Okay. Headline is surprisingly strong Q1 performance relative to their own expectations. They exceeded revenue and profitability guidance and delivered a significant beat on cash flow.
Right.
This was fueled by substantial sequential growth in security solutions, the successful ramp-up of key programs like DMDC and TSA PreCheck, and the benefits of last year's restructuring contributing to lower operating expenses.
And the outlook points to continued year-over-year growth, which they expect to accelerate in the second half, though with that expected near-term sequential pressure on overall margins because of the changing mix within security solutions.
Correct. And again, that striking turnaround to positive cash flow generation in Q1, coupled with management's expectation for continued strong cash performance, they say will outperform adjusted EBITDA. That's really a standout element of their commentary.
Okay, finally, a provocative thought for you, the listener, to consider after diving into all this detail with us. Given the significant accelerating shift in Telos' business towards these high-growth security programs, given the forecast and near-term margin pressure that comes with that specific mix, given the substantial multi-billion-dollar new business pipeline sitting there for future potential, and the rapid turnaround we just saw in cash flow generation in Q1, how should investors truly value this business today? Is 2025 best viewed as a transition year, focused on execution and scaling the current big wins, setting the stage for potentially accelerated free cash flow generation and future pipeline conversion beyond this year? Or does that sequential margin contraction coming in Q2 and the current reliance on just a few key programs still pose risks that aren't fully captured by the recent cash flow strength?
Yeah, it's a picture with competing forces, isn't it? And different timelines definitely at play. A lot to think about beyond just the surface numbers.
Indeed. That wraps up this deep dive. Thanks for listening.